belts. And with me on live television is David Buckland. He's from the Montgomery Fund. David, thank you for joining us and for spending your time this next hour with us.
Pleasure.
David, do we really need to tighten the belts and get really scared now?
The biggest issue now, apart from the 10 or 12 times price to income ratio, the high debt to disposable income ratio, and the bubble and the 2% cash rates, which are record lows. The biggest issue now is that long bonds all around the world have started backing up. So we've had this tremendous bull run in 10-year bonds globally, and in recent months we've seen them back up across the board on average by about 0.6%. Now, a lot of people go, well, so what? It's only up 0.6%. But what a lot of people have got to realise is that interest rates in most Western world countries such as France, Italy, Germany, UK, England, Japan, probably average sub 1 percentage point. And Australia, if you took the average of those 7 countries, they averaged under 1% at the 10-year area. Now they're closer to 1.6%. So that is quite a sell-off proportionally. And at the end of the day, 10-year bonds have a major influence on discount rates and sentiment. And I think that's, Tony summed it up very well in terms of the indebtedness and the ratios. But I think that's the thing that we haven't really touched on as an economy yet.
That's true. And with that message, I think we have a caller. Abe, are you there?
Thank you, Rudy, for taking my call. I'd like to ask the panel about 7 West Media. They've come up with some rights issue. Does the panel recommend that one gets these rights issues, or if you're a shareholder, or do you think we should let it pass?
Abe, are you a shareholder, Abe?
Yes, I am.
I suspect that you are. In what kind of delusion were you at the time when you actually bought the shares?
That answers his question, Rudy.
Anyway, Abe, that was my free call on the stock. But I will take you now to David, and I think he has a little bit more to say about 7 West Media than I have.
Yeah, look. This is one that obviously many people have been forced to take up because they to avoid dilution.
Yeah, but I think that's how a fund manager thinks. But I think if you're a retail investor, I don't think you're not that worried about dilution. I think it's more about like, do I put extra money in or not?
Correct. But at the end of the day, let's look at the business model of the company. And at Montgomery, we're very focused, Abe, on understanding a business model, understanding its qualities and understanding its prospects. And for us, a stock like, and then finally, and most crucially, trying to buy it well. Yes. So you've got to have quality, you've got to have good prospects, and you've got to try and buy it well. So for us, 7 West Media just doesn't unfortunately meet the criteria that we're looking for.
So you would actually say to the shareholder, Abe, don't put extra money in there.
I think, look, there's 1,860 stocks listed on the ASX. I think there's plenty of better stocks that offer better attributes.
The email is basically saying, I thought the banks were considered overvalued and Woolworths not a good growth company. Yet they all have come up in rather large amounts. I sold out of these and now wish I hadn't. And now the question obviously is, are they now a buy again or have we missed it? Well, that's a funny one. Obviously, my 5 cents worth is don't get taken away by day-to-day movements. And after a big fall, like Woolworths and the banks have experienced, almost without exception, they always bounce at some stage, but it doesn't mean they are good or bad long-term investments. That's my 5 cents. Let's pass it on to David. I think when we talk about long-term investments, he's the man.
Yeah, so with Woolworths, we had a very big conference call with the former CEO of Aldi in the UK, and this is a threat that's occurring across most of Western Europe and the UK and Australia now, where these superb discounters come in and very much have a very focused business model. It's a low margin business model, and their earnings are something like 2% of sales. Woolworths at the EBITDA line is the highest margin grocer in the world at 8% of sales. So what happens is that Aldi have come in. They now have 300 stores in Australia. They do about $10 million a store. It's a $3 billion business. Woolworths is a $50 billion business. So you think 3 versus 50, not a big deal. But I am projecting the 3 will become 6, as in they'll go from 300 stores to 500 stores over the next 6 or 7 years. But most importantly, from our point of view, is Woolworths' 8% margins to me seem unsustainably high. Secondly, as the margins come back, the rating of the stock will also come back because people will say, hey, it's no longer a growth stock. It's a very solid grocer, but it probably at 8% EBITDA margins has been over-earning. So it'll come through a bit of a decline in its margins and also a de-rating, and hence the move from mid to high 30s to mid to high 20s. And it's a sort of stock that fortunately we've been avoiding now for the last 6 or 7 months, but it's not till it gets to maybe the low to mid 20s before we even have another look at it.
Yeah. Well, I can add to that is I think the most bearish team of analysts I follow is Morgan Stanley, and they have a price target of $24, which pretty much confirms that story. I actually think this is just highlight because I actually like your explanation of Woolworths, and I think that's the key of understanding Woolworths now, is to understand that out of $50 billion of revenue, 3/4 of that trades on a very, very, very high margin. So if something happens to the margin and you multiply that by, let's say, 35 billion, that translates into a lot less profits. And I think that's what people tend to underestimate, I think.
I think it's also important to look at the French example, the UK example, the German example, where they've gone in and they've done it over 10 or 20 years. They are a very well-run business. They use their own cash flow. It's effectively a family business, and it runs the business on the smell of an oily rag. A lot of people don't like shopping there, but for a lot of Australians now who are very, very, very price conscious, of course it only offers 1 tomato sauce and Woolworths offers 28 tomato sauces, but for a lot of Australians who are very price conscious, it's got a catch.
Yeah, I know, and I know from personal experience, because I am from Europe, Aldi knows how to run a distribution channel, and it's on very thin margins, and they're really expert in it, and you're right, that's what they do. Caller, is that William? Do I hear your voice?
Yes, you do.
Okay, William, and I'll take a wild guess. IPH.
How did you know?
Hey, I'm better than people think I am.
I'd particularly like to hear David's view of the intrinsic value of that stock.
Okay, and then we will.
And the outlook.
And absolutely, and we will serve you at the best of our abilities, because here he is. He's David.
Thanks, William. So ticks box number 1. It's a brilliant quality business with a very high return on equity and incremental equity. For those that don't know, IPH is known as International Patent Holdings. Its main subsidiary is a business called Spruson & Ferguson, which has been run by its current managing director for something like, I think he's been with the business for something like 4 decades. What this company does is it has enormous market share in the trademark industry domestically, and also has a large positioning in Asia out of Singapore. And so if any sort of, I'll call them innovative company has a trademark, they have to pay a certain amount of money, which is crucial every year to roll that trademark over and to own that trademark for a long period of time. And every time they add to that trademark, they have to spend more money. And Spruson & Ferguson, or IPH, is the brand leader in this country. They call themselves IPH because there are other similar businesses in this country which they may end up acquiring. And that was stated in their prospectus when they listed in December last year. So they listed at $2. They're currently $4.60. So it ticks box number 1, quality. Box number 2 is prospects. It has excellent prospects, and I believe that Asia will become a significant part of this business over the medium term. Box number 3, however, is price versus intrinsic value, and this is where at Montgomery we're having a bit of trouble coming to grips with the valuation. As I said, floated at $2, is currently $4.60. It's got a bit hot for us. Our valuation is in the 3s, sort of 3.5, 3 3/4 or thereabouts. So at $4.60, it's just got a bit too hot for us, and we unfortunately have sort of departed the scene because we do love the organisation.
Can you imagine? It was more than $5 a few weeks ago.
Correct.
I mean, it's probably the most successful IPO we've seen in a while.
I think the problem with Australia, really, at the end of the day, is these businesses have an annuity-style business model, very strong cash flow, very good growth prospects in Asia, and a certain amount of scalability and a little bit of M&A potential thrown in. They are few and far between.
Yes.
And so when the large institutions get hold of them, they just never let them go.
Yes, yeah, exactly. I mean, well, I can add, I'm looking at consensus forecast on F1 Arena. I mean, since it has come down, officially it's now trading on a P of 20 for next year, but that's double-digit growth incorporating, so you have to be confident that that growth will come and will come uninterrupted at these levels, of course. I mean, never mix dividends with weakness, because before you know it, the dividends are no longer there or they have to be cut. And that's the risk when you go for companies that are in trouble and you only hold them for the dividends. That's just my 5 cents worth. David, I'm pretty certain you agree with what I just said.
Absolutely. So, Graham, it's a very bad habit to get into and just look at sort of the yield on a particular stock, because that assumes that yield is sustainable over the very, very long period of time. And the question with Metcash and the sustainability of that yield is the future of the business. And as I mentioned earlier, Aldi's coming into Australia and really starting to cause a bit of havoc amongst this enormous duopoly between the Coles group and the Woolworths group. So if it's causing a little bit of havoc amongst these two gorillas, imagine what it's doing to Metcash. And we've seen a fairly negative share price reaction in recent several months. So I would stand back and question the sustainability of the dividend, because I think the future may not be so great for that company. And I would really try and get in the habit, if I was in your shoes, of finding stocks that have really strong growth prospects. Because if they have really strong growth prospects, their dividends in 2 or 3 or 4 or 5 years could be a lot greater than when they are today. And that, to me, is a much better way of investing than just looking at yield today with a very singular focus.
Yeah.
Yes, I am.
Okay, Brian, shoot.
Brian from Brisbane, mate.
Shoot.
Good to see you on there, by the way.
Thank you.
Ring about 2 stocks, Challenger Financial
Yes.
and ResMed.
Okay. Anything in particular you want to know about these?
Yeah, Challenger, I've bought into Challenger. I've got a few of them. But I was wondering about putting a bit into ResMed. What's your opinion? There's a lot of people knock it and, can you give us your opinion?
Okay, well, we shall ask for it. And I do happen to know that the gentleman on my left is a big fan of one of those stocks, but I'll pass on the microphone.
Thanks, Rudy. Yeah, Brian, we very much like Challenger. It's as obviously you do. I mean, it's obviously got 2 tailwinds. One is the superannuation guarantee, which is going to take the funds from about $2 trillion to $7 trillion over the next sort of 18 or 20 years. But within that, that growth, the annuity side of the business, or the sector, if you like, is going to grow much, much more quickly. So Challenger at the moment has a very, very strong positioning in the annuity stream, and at the moment it doesn't have a lot of challenges, excuse the pun. So we very much like it. We think its valuation is way higher than the share price, and as I say, it's got a very, very nice tailwind, on a multi-decade view. No doubt other competitors will come in over time, but no significant ones at present. On ResMed, look, it's an excellent business. good prospects, still massive untapped market. But for mine, it's just its share price more recently has been a little bit on the expensive side, but it ticks a lot of boxes in terms of high quality business with good prospects and good tailwind, but just doesn't sort of tick the really cheap price box.
David, can I ask one question about Challenger?
Yes, mate.
I know everyone, pretty much everyone is convinced that, I mean, that they do have that long-term prospect which looks really good, but in recent years they seem to have had a lot of problems in actually making profit growth.
Yeah.
And why is that?
Look, I wish my colleague Andy Macken, who's the genius behind that stock at our joint, was here, because he could give you a very, very good answer. And I don't actually know the absolute answer of why they haven't been turning the prospects into hard earnings. All I know is that our view is that we're very confident they will over the medium term.
Yeah, because I have a suspicion that that's the reason why the share price has been held back a little bit. Because investors do look at profits.
Of course, but you know, we're trying to invest for the medium term, not the next 5 minutes as well.
Yeah, exactly. And well, let's start with NAB. David, what would you do? You're cash strapped, and you have a rights.
Just end up taking the proceeds at the end of the end of the process, I think.
Yes. What would be your view on NAB in general? Do you have a view on?
Look, they're raising 5.5. Look, it's been the dog of the four banks. Okay, yes. And why has it been the dog of the four banks? Because these guys 10, 15 years ago, you know, thought they were geniuses, and they went over to the US and they went over to the UK and they bought businesses like Homeside and Clydesdale and other sorts of, you know, Yorkshire banks and things like that. And they all thought they were very good at running banks. What they didn't realise is they were very good at running an oligopolistic sort of scenario in Australia where they were one of four. Yeah. And so, you know, it's been a disaster, the US and the UK for the NAB. And fortunately, the current management is trying to put that disaster behind them. The $5.5 billion, I think about 3/4 of that is going into the Clydesdale operation, the UK. It's going to be demerged and basically kicked out. Yes. And they have to shore it up with this, you know, the vast bulk of the $5.5 billion, probably something like close to 4 of the $5.5 billion. And so the shareholders pay again to actually boot it off the books. But what comes back to where it should have been from day one, and that is a very, very strong, domestically focused, when I say domestic, Australian and New Zealand focused business. Yeah.
CSL's share price is sliding downhill. And also, what does the future hold for CSL? Less than a month ago, it looked to be heading to $100, says the email. And I mean, I have a reason, but I'm going to keep it to myself for now. David, is there any reason why CSL shares are now venturing further and further away from the $100 mark, you think?
Look, it's been one of the great industrial companies in Australia's history in the last 10, 15 years.
If only we had 40 CSLs on the share market, huh?
If only we owned 2 of them.
Yes.
You know, what a superb business. So, look, these things move up and down 5 or 6 or 7%. It's not a big deal. No. The question is, are the prospects for this company still intact?
Yes.
I believe they are. Is it expensive at $100 or thereabouts? I think it is a bit expensive. But you know, that's what you get with quality. They sometimes do get a bit expensive. And so I think, just back to my comments in the introduction, is when long bonds go up from 1% average across 7 major economies to 1.6, there's a lot of sort of very high PE stocks that just people say, oh, just pull that PE down, that rating down a little bit. You know, there's a little bit of a scare coming in the long bond market. I'll just pull the rating down a bit, and it's not a big deal. Yeah. It's just that the sort of excitement's just come out a bit. Now, just to sort of give you a feel, the market 3 years ago was roughly 4,000 points. It's been more recently close to 6,000 points. So it's gone up close to 50 percentage points in 3 years. Now, we've done some work at Montgomery that basically says of that increase, about 20% has been earnings related and about 80% has been the compression of interest rate related, which has meant PEs have re-rated, okay? So 80% PE re-rating, 20% earnings growth. So all that's happening is sometimes when PEs go from, you know, 13 or 14 to 17 or 18 or 19, they just come back a little bit when there's little bit of nervousness around.
That's true. And I do think, just to add to that one, I think there's, at this point in time, there is a portfolio reshuffling going on where people actually take a more of a growth bias in their portfolios, and they're just selling the good stories, the stories that have done it all and are looking expensive. And obviously the likes like Orica and Instax Pivot, they look very cheap. And it's not everyone's taste. It's definitely not my taste, but I think that's one of the reasons why healthcare stocks like Ramsay and CSL have been coming down, because they've performed so well and they've looked a little bit pricey.
Sure, markets rotate.
Exactly.
That's right. But the question as investors we've got to ask ourselves is, what about a 3-year view rather than a 3-day view?
That is definitely true. And no longer realestate.com. Anyway, David, all yours.
Yeah, in short, the answer is yes. High quality business, good prospects. Obviously, missed the number in the third quarter. You know, we then ask ourselves, if a company misses a number, is it permanently in trouble, or is it just temporary? And our view is it's temporary. It'll be back. I think the very nice tailwind, and I think when you get these sort of fairly severe pullbacks, I think it's come back from roughly $50 to low 40s, 41 I think you mentioned. You know, that often provides an opportunity, particularly if you're prepared to take a medium-term view.
Yeah. What's your view on the increased competition, it would appear, from Domain?
We're not losing a lot of sleep over that increased competition.
No. So that's fair and simple then. I think it's probably fair to say that the pullback of REA, apart from the fact that they did miss the numbers, is probably similar as the pullback in CSL, I think.
Yeah, so you have a superb business that's performed incredibly well over many years, and it ends up to some degree getting a little bit priced for perfection.
Yes.
And then what happens is, when it misses a number for a quarter, perfection isn't there, and the market is brutal, particularly at a time when, you know, long-term interest rates tickle up a little bit, it's on a P in the 20-somethings or whatever it might be, and people just go, I'll just derate it a little bit. And the moves can be quite severe, quite quick.
Yes.
But if you're a medium to longer-term investor, it can also create opportunities, as long as you believe that the prospects remain intact.
And we should not forget, this is a company that grows not by 10 or 12%, it grows by 30 or 35% a year.
Well, a lot of those, particularly on a global basis, a lot of those internet-type business models are extremely scalable, and their incremental return on equity is very high, because, you know, it's like some of these businesses just don't need a lot more people for their revenue line to be 20 or 30 or 40 or 50% higher. So they are very operationally scalable.